in this day and age, in terms of, certainly from an exit perspective, it's very important. Most investors are looking at businesses that are actually sustainable, that they're actually earning money. There's less money being thrown around in the VC community, in the investor community, whether it's angels, on business cases that actually aren't delivering. So proof of concept is really important. I've been involved most recently in a couple of industry roll-ups, one in Europe. We raised €22 million from 3 VC funds in June 2008, and we did 6 acquisitions back to back in 6 months in Europe. And at the end of that, we ended up with the largest independent mobile software vendor in Europe. So these guys, it's called Myriad Group, it's now listed on the Swiss Stock Exchange, 900 staff, and it had, as at the end of December, had €37 million cash in the bank. So we acquired these businesses, we didn't use cash, we used script, and all the cash we used just to pull out the businesses. So those 3 founding VCs that got involved in that business for 2 reasons. One, the management in the business. These guys were fairly switched on in terms of the mobile software sector. They understood it well, they've worked in it, they had turned a startup called Magic 4, which I was in the Phillips, it was spun out of Phillips, and I was part of the guys that gave them the foothold in terms of funding. So we, at Phillips at that time, we invested €1 million into their business, and they sold it to OpenWave 4 years later for, I think it was about €78 million. And so they had runs on the board, and so the VCs were looking at these guys going, okay, a good management team, they know what they're doing, really difficult market conditions, especially in Europe, and they were prepared to back them. But every acquisition that was done was based on revenue. So 6 acquisitions were done. Only one was non-revenue earning, and that was Sumi, which we bought from here in Australia back in June of last year. But the other 5 had reasonable revenues coming through. They weren't more profitable, some were losing money, but we knew that by consolidating them and getting some synergies out of the business, we were able to make some money for shareholders. Now that business is now market cap of 200 mil. Original investors still own about 66%. So for them, during a very difficult market climate over the last 2 years, they've almost had a 10-bagger, which I think most investors have gone down by a factor of 10 in their investments within the same period. So
does anyone know what a 10-bagger is?
A 10 times multiple when you're investing in 12 months.
So I know that things might be changing somewhat because the climate's changed, but some years ago, particularly in the heady days of the dot-com boom, the Silicon Valley VCs would not invest in something unless they could foresee getting themselves a 10-bagger. Put in $1 million, get $10 million back. Put in $100 million, get $1 billion back. Like Google, whatever it is. Google was. Oh, right, okay. What was Google?
I think it was $25 million in for each of Sequoia and Climber, and I think they got, how much was Google worth at its IPO? They owned over 10% of it, so $8 billion each or something like that.
Nice. What'd you do with $8 billion? The opposite end of the spectrum of $8 billion is probably about the amount of money that Ilkka put in his first angel investment. Interestingly, most people enter this space by starting a business, raising some money. You came from the other side, you came from the corporate space, and then your first entry point into the capital raising space was as an angel investor, right?
No, actually, it was back in, I think it was about 1986. I just finished university and I was working for one of my university lecturers. And I'm a bit of a Westie. I grew up in Blacktown, and he had a client called Big M Motor Records, which was based at Dunhead Circuit in St Mary's. So if anyone's been out that way, it's a lovely little suburb. And I invested, I think, $20,000 at the time, which was a lot of money for me back then. I was probably earning $25,000 per annum. And into this Motor Records without actually doing proper due diligence. And I turned up one day at the Motor Records, and it was run by this bit of a character. And there were bullet holes in the front door. And I thought, that was a bit sus. And I started talking to the owner, and And I was a silent investor, so he wasn't actually aware that I was actually an investor at that time, but I was helping him out, and turned out that he was doing illegal pink slips, and he was laundering money for the local whorehouse. Where he was credit card machines, so I lost a lot very quickly. So I kind of, for the next decade or so, I kind of shied away from investing and getting involved in anything slightly entrepreneurial, and went down the corporate route for a while.
I told you he was a shady one. In terms of the crowd that we have here, I'm gathering that most people here are here because they've got their own business or they're looking at creating their own business. Can you raise your hand if you're an entrepreneur, business owner, innovator? Wow. What are the rest of you here for? The drinks. We had the event last week, and it was all about online marketing, and I kept talking about ROI. And there was this chap at the end of the night who was complaining that we didn't address the topic that he wanted to. And he'd been at the bar for about 2 hours, and it turned out that he drank $200 worth of scotch. I said, you spent $45 to get here. What's that? 400 ROI, isn't it? Or the money that you drank in scotch. I gotta stay away from the jokes. Boy, oh boy. In terms of raising money, I mean, like, what if I gave a couple dollar figure ranges? There are certain rules about soliciting capital without a prospectus, and they don't apply here, so don't worry, because you're not trying to solicit capital and you haven't told me how many shares you want to give me. But if I ask how many people are looking for, say, angel funding between $0 and $300,000, can you put up your hand, please? 300 to $1 million. More than $1 million. All right, well that will help us in terms of what we're talking about. Very helpful. Mike.
Yeah.
Now you would have Mike, pass the mic to Mike. Mike, you would have sat on the other side of the table as people tried to raise money from you, and you would have heard some things that annoyed you to tears, bothered you to tears, like same sort of stuff, that mistakes that people would make again and again and again when seeking capital. Which one of those mistakes did you make when you went out seeking capital? Perhaps you want to talk about the things that people did that bothered you.
Exactly. So I wouldn't say bothered me, but I think the things that are going to make it tough to raise money. Talking about if we only get, this is a huge market. If we only get 1% of the total market, that's a common thing that people say.
I love that one. All I need is 1% of the Chinese market, and we'll all be rich.
That's one. The other thing is people tend to focus on valuation pretty early and how much dilution or how much of the company they want to sell. And I think the difficult reality is, and you need to get, I think your mind around this, if you're going to go out kind of widely to raise money, is that the market's going to determine what your company's worth, and then I guess you can adjust how much you're going to raise to adjust how much you're going to sell down. But it just may be, if you've got something fixed in your head, I think it's actually very difficult to go out and say, I'm raising money at this amount.
Like my business is worth $10 million and I haven't generated any revenue yet.